Welcome back, everyone. Michael here with Offshore Citizen. Today, I am going to dive into the subject of Biden's proposed tax changes. I'm going to give you my reactions. I'll go through kind of point by point and tell you what I think as a tax expert and from the perspective of somebody who also cares about justice and things like this. At the same time, I'm going to give a perspective which I don't think really anyone has been giving, which is a lot of people have been asking, hey, if you're a foreigner who's operating in the US, has a US company, etc., how is this likely to affect you? I'm going to cover all of that and more coming right up. Before we get started, though, there is a wonderful thing you can do which will make you so much more successful, which is to smash the subscribe button, click the notification bell if you haven't done that already. Really appreciate it when you do that. It will get you updated on all of our upcoming videos, so click the subscribe button. Also, if you like the video, please like the video. If you have questions later, put them in the comments, etc. If you would like assistance with your international structuring, tax planning, etc., go and contact us. You can book a call with me, cardi.fm/Michael Rosmer. There's a link below, as well as visit our websites, offshorecapitalist.com, offshorecitizen.net. Now, let's dive into this subject. So I have the list here so I can follow along with it as we go. Let's see here. So I think I'll just skip down to this details. Okay, so loosely speaking, I think maybe I'll set some context with this before we dive into some of the specifics, which is what they have been saying from the Biden campaign in things like debates and what is supposedly in the policy differ somewhat. So, for instance, if you watch the vice presidential debate, you would see there was a part where Kamala Harris was mentioning how they were going to repeal the Tax Cuts and Jobs Act, which is the Trump tax reforms that were brought in at the end of 2017. And then Pence was saying, well, hang on, that means people are going to pay a whole bunch more tax. And they're like, no, they're not going to pay taxes. Like, well, you said you're repealing that and it gave them tax cuts. So are you going to suddenly, are you repealing part of it? Are you repealing all of it? What's your story? And they didn't clarify, which was really stupid as far as I'm concerned. In addition to that, Kamala Harris in that debate said something which was patently false as somebody who understands taxes and understands that. I'm not sure whether she was simply ignorant of the taxes, wouldn't surprise me at all, or whether she was saying something just as kind of a smoke screen and she was aware that she was lying, right? But what she said was oh, hey, the Trump tax changes have incentivized big companies to go overseas. This is completely false. It is the exact opposite of what is true. Okay, we work with clients all over the world all the time, including clients from the US, and I can tell you it was the number one, it was so powerful in terms of getting companies to bring money back to the US. Whatever you want to think about that, it certainly made things harder for our clients, right? I think that from a US standpoint, they were good, right? It was beneficial. And the reason for this is it achieved two things simultaneously. One was it made the US much more competitive. So tax rates had been as high at the corporate level as 39.5%, I believe it was, and 35% even at that level. They were the highest in the world, or in the developed world. Okay, so the US was a very non-competitive place to have a business from a tax standpoint. To give you some idea, and I'll dive into this in a minute when we get into the proposed tax changes, but the OECD average is just over 20% and the EU average is around 20%, okay, just over 20%. So it was interesting to me that companies weren't moving from the US to the British Virgin Islands or Bahamas or something like that. They were moving from the US into Canada or UK, right? Well, what does that tell you? That just tells you that, hey, listen, your environment is really not tax friendly. So the first thing that Trump tax changes did was they reduced the rate to 21%, making it much more competitive for businesses to be in the US, right? At the same time, they introduced GILTI tax, and GILTI tax made it really hard to keep money offshore. And so the combination of these two things meant it was well, we might as well go and operate in the US. We might as well bring money back to the US, okay? And so from that standpoint, I think it made perfect sense that that this would, it was very favorable from a US standpoint. It all fit with the Trump objective of America first, bringing things to America, et cetera, et cetera. They definitely incentivized that through what it was they did. It was not good for our clients, right? At least not our American clients. But that being said, is what it is, right? So let's go through some of the specifics. So we're starting with the effects on payroll tax and individual income tax changes. So the first is imposes a 12.4% old age survivor and disability insurance, Social Security payroll tax on income earned above $400,000, split evenly between employees and employers. This would create a donut hole in the current payroll where the wages between $137,700 and current wage cap of $400,000 are not taxed. Now, honestly, I don't really know why you would put that limitation between $137,000 and $400,000 as opposed to just having it go all the way across. It doesn't really make a lot of sense to me. But let's kind of look at the logic behind this. So pros and cons. So the con of this, of course, is it raises the cost of employing people, right? To give you some idea, I posted on Twitter, you can go to @MichaelRosmer on Twitter if you want to go and check out, and a little while ago I posted these stats of if you made 100,000 euros a year or 200,000 euros a year, what the cost was to employers and how much the employee actually made across all the European countries, or at least maybe the Schengen countries. I don't recall seeing places like Bulgaria in there. But so basically these high tax countries. So that was one thing, and you'll see that, listen, in places like Belgium, it's really expensive to employ people. And so what does that do? Well, that incentivizes people not to employ them in your country. Now, I'll do some other videos in the future, but I think that people radically underestimate how much the world has changed in the last 10 years due to the effects of the internet, e-commerce, mobile devices, YouTube, things like this. And I think that I predicted this. If you go back and watch my video from when Corona hit, I was kind of like making some predictions about what the impact of it would be. And one of them is, I think places like the US and Western Europe are going to be big losers on the employment front because increasingly what companies are going to see is, hey, listen, we can employ people abroad. They don't have to be in the office. And if they don't have to be in the office, then why would we pay high local tax rates, right? That's just, I think, going to be the norm. And so what you're doing is you're making your labor force less competitive. Now, to be fair, you're saying, okay, well, 137,000 to 400,000, so those people, I guess, not so much. I don't really understand why you would pull that out, though, because a lot of the people who are going to be displaced are below 137,000. And I think that it really, to me, reflects this bias against rich people, okay? So let's dive into this really quickly. There's a common conservative claim, which is that the top 10% of income earners pay 70% of the taxes, okay? This is only true, though, so that is accurate. From a federal income tax standpoint. So basically the argument is, hey, listen, it's already fair because there's a disproportionate amount of tax paid there. Okay, fair enough. Where that's false is that although that's true for federal income taxes, it doesn't account for payroll taxes. Federal income taxes are about 50% of the overall tax revenue, and so the payroll taxes are regressive, meaning that they affect the lower portion much more highly than the higher portion. This is because of caps. Now, in some countries, they don't have caps, right? But for instance, in Canada, in Bulgaria, in places like this, there's quite low caps, right? In Canada, it's a little over $50,000 Canadian, so quite a low cap on CPP and EI, which means that over and above 50,000, it kind of compensates for the higher tax rate that you're paying. Is this good for your system? Again, I'm not a fan of making it less competitive for people to hire in your local country. I think that's one of the things that, say, Trump got good or got right. And this, I think, is kind of a bad move in that respect. That being said, I think what you're going to see is you're just going to force people to do, stock-based or other types of compensation. So it doesn't necessarily really achieve much. So I think it's an ideological change. I don't think it's a really great change. I probably wouldn't do it. But, if you want to say, okay, well, maybe or if I did, I would do it probably all the way across. I think that the bias against rich people is they're not really paying attention to what the consequences of doing that are. So let's see here. Reverts the top individual tax rate for taxable incomes above 400,000 from 37% to 39.6%. Okay, so basically it had dropped, whatever. It's not a substantial difference. We're talking about less than 3% change. The bigger thing would be when they brought that in, they killed the state deduction, the state tax deductions that were available. And that actually forced up taxes for people, say, in California, but lowered taxes for people in Texas. which interestingly probably has a bias towards Republican states and a bias away from Democratic states. It'll be interesting to see how they play that out. They don't have details about it here. Tax long-term capital gains and qualified dividends at the ordinary income tax rate of 39.6% on income above $1 million and eliminate step-up basis for capital gains taxation. Okay, so this is basically the proposal that Warren Buffett has been making for quite a few years, right? He's saying, hey, listen, why are we incentivizing people to invest rather than have labor? I think that there's merit to that. I think that if you pay attention to, hey, listen, how is wealth built? Wealth built is built in what you own more than what you do. And so, trying to jig that so that it's kind of more fair probably makes sense. That being said, what's the flip side of it? Well, the flip side of it, and I think this is something that, they are kind of ignorant of, which works in the favor of us and our clients, people like this, who are abroad, is that foreigners aren't paying that, say, on U.S. stocks anyway. So if you're not familiar with this, if you're a foreigner and you invest into the U.S., now if you're buying real estate, you're going to pay tax on that as U.S. source income. But if you're investing in U.S. companies and the company sells or you're selling the shares, you don't pay any capital gains on that. You pay no tax at all on that. So foreigners are benefiting from the U.S. market and locals are not benefiting the same way. So that's like a really interesting thing. Again, it works in favor of our clients. I don't think that it's smart from the U.S. standpoint. I think that it's pretty dumb. They probably should be, they have withholding taxes on dividends. Why wouldn't you have withholding taxes on capital gains? It's an interesting question. But, so is this fair? Well, I mean, first of all, I don't know why you're saying, hey, listen, above $1 million. I think it, again, shows this bias against rich people, right? I'm guessing that that's on a per year basis, so you can probably do things to simply sell out over a period of time in order to keep that down. You're selling out 900,000 a year and you're kind of dragging it out potentially. So I don't know that it's a particularly great thing, but that being said, it probably, like from a tax justice standpoint, it probably should be in place. So that's, caps the tax benefit of itemized deductions to 28% of value of those earning more than $400,000, which means the taxpayers earning above the income threshold with tax rates higher than 28% would face limited itemized deductions. I mean, again, this is a bias against rich people, right? That's basically what you're saying. Like basically as I read through this, it's like, hey, if you're a wealthy person, a high income earner, et cetera, kind of a 7-8 figure income earner or somebody with net worth in mid 7, high 8 or like low 8 figures and above, this is really bad for you. It's they're coming after you, which by the way reflects kind of, we had a lot of people contacting us lately, looking at moving out, putting assets into trust, et cetera, et cetera. We'll see if we come to it here, but I don't know if they included in this. When I read over these things beforehand, it wasn't here, but one of the things they're also talking about doing is taking away the benefits of the gift tax. They doubled it, the amount that could be given in inheritance, et cetera, to people, and they're talking about repealing that. So anyway, phases out the qualified business income deduction for filers with taxable income above $400,000. Okay, again, what are we seeing here? We're just seeing a bias against people who are wealthy. Now, why is this thing a bit of a problem? So the whole point about this thing here is that this favors particular business. There's certain business structures where you get double taxed, okay? And so the idea is, and this is again kind of the argument against the qualified, the capital gains rates going up, et cetera, is like, look what happens. Say you have a C Corp, okay? A C Corp pays taxes, 21% plus whatever the state taxes are. Then you distribute a dividend. Now you get taxed fully on that, right? So what are you kind of incentivizing? Well, you're kind of incentivizing, you're saying, hey, listen, I might as well pay it out as wages instead, because then I get a full tax write-off for it at the corporate level and, go and operate here. But then they're saying, okay, great, well, we're going to slam these other payroll taxes on you. And so, we're going to bring this back up. The idea was that, of course, because of the fact that you have this double tax in small businesses, they set up some rules which allowed you in a flow-through entity like an LLC or an S Corp to be able to get a lower tax rate via this deduction system, right? So I could do another video on it in the future to explain how it works. But anyway, the bottom line is that you would end up with this lower tax rate, which was again, it's designed to kind of favor, eliminate this kind of double taxation that disadvantages business owners, right? So I think, like, again, in my opinion, you want to be encouraging small business. You want to be helping small business owners. And so when you start putting things in place that make it tougher for them, making it look like they have to start planning, et cetera, what are you going to see? I think what you're going to see out of this is more people are going to do more sophisticated planning because it's going to start to pay off, right? Maybe it doesn't pay off right now, but now you're like, okay, well, hang on, I'm hit with this capital gains thing. I'm hit with potentially higher taxes in terms of the payroll taxes. Potentially I'm in a situation where the qualified business income deduction gets eliminated for me. It's like, okay, well, now I'm paying an extra, what does this work out to being? Potentially, you could be paying an extra 20% or something, right? Well, you're talking about people who are earning over 400,000, so 20% on $500,000 is 100 grand. You can afford some pretty good tax planning for 100 grand, right? So I think that they're going to certainly disincentivize what it is that they're doing. They're going to incentivize people to be more aggressive about how it is that they figure out ways to plan. It's good for the tax planning industry. I don't know that it's particularly good for the country. They're claiming they'll increase their revenues. Okay, that's possible. The counter argument, of course, is, hey, listen, is now a good time when things are going not so good for the economy? That's a whole other thing. Expands earned income tax credit for childless workers, age 65 plus, provides renewable energy related tax credits to individuals. Okay, probably good to encourage those things. Expands the child dependent care tax credit from a maximum of $3,000 to qualified expense in qualified expenses to $8,000, $16,000 for multiple dependents. I mean, again, people who, I guess you could say, hey, listen, you have kids, etc. That's a bunch of expense. Like, okay, it's probably decent for helping people out who actually need it, right? A bunch of people are going to benefit it from who don't need it, but hey, that's fine. For 2021, and as long as economic conditions require, increase the child tax credit from a maximum value of $2,000 to $3,000 for children 17 and younger. Okay, I mean, that's fine. Reestablishes the first-time homebuyers tax credit, which was originally created during the Great Recession to help housing market. Biden's homebuyers tax credit would provide up to $15,000 for first-time homebuyers. Okay, I mean, getting people into home buying is probably a good idea. The reality is that it's become quite hard for people who are kind of at the getting started, so fair enough. Biden's tax plan also includes the following proposed changes to business tax. Okay, increase the corporate tax rate from 21% to 28%. I think this is a dumb idea. I think that this is a horrific idea. Why? Well, because 21% is about the global norm. And why would you want to be less competitive than the global norm? It's just this ideological, how did you even pick 28%? I feel like it's like, oh, hey, that's a fair tax. Well, taxes are not all about being fair, okay? Yes, fairness matters, but you know what else matters is a competitive marketplace. What you have to understand is that countries compete for your tax dollars, okay? The same way that businesses compete for your business. And so right now, I can tell you that businesses are like, should we go to Canada? That's a wash. There's no advantage to moving to Canada, really. In fact, in a bunch of cases, it's slightly more expensive to be in Canada. Well, at 28%, it's slightly more expensive to be in the States, right? So that's a disadvantage. Right now, just slightly, the UK tax rate slightly lower than the US, but not significantly, unless you start counting state tax. Now you're going to make it less competitive? Come on, this is not a good idea. And we can run down the list of countries. I mean, we're talking about places like Sweden, Denmark, Finland, Norway. Like, all these places have tax rates that are about what the US has, typically like around 22-ish% is normal in that part of the world. These supposedly, socialist countries, they're more like social capitalist countries, but social capitalism. But anyway, that aside, you're becoming less competitive. Why would you want to become less competitive when businesses are easy to relocate? So I think that's a bad idea. I think that I don't think they know what they're doing. And I think it makes it bad for all the businesses operating in the US. Creates a minimum tax on corporations with book profits of $100 million or higher. The minimum tax constructed as an alternative minimum tax, corporations will pay the greater of their regular corporate income tax or the 15% minimum tax while still allowing for net operating loss and foreign tax credits. I don't think that, so the devil would be in the details on this one. I think that the way they approach this is really, really key. I'll hear all these comments where people are like, oh, hey, this company doesn't pay any taxes. Yeah, but they had no profits, So And the argument is, hey, they should have to pay minimum tax. Like, well, from what if they don't have profits? So the question is, all right, how are you getting to those numbers, right? What are you calculating here? If you're trying to tax companies that aren't making money, like Amazon for a bunch of years, for instance, I think that's a bad idea. Because the whole point is you're incentivizing companies to reinvest. When companies are incentivized to reinvest, that's good. The problem with a lot of companies is they don't reinvest, right? So this just kind of reduces their ability to do that. It seems like a bad idea. And then because they're giving them foreign tax credits, et cetera, I don't think you're going to solve a lot of the issues that are there anyway. So I think that you're going to incentivize companies to pay taxes abroad. They get a tax credit for it. They don't have to pay the 15% alternative minimum tax, and off they go. They just reallocated where their income and expenses were. I don't think that it makes a lot of sense. Doubles the tax on GILTI, so global intangible low tax income, earned by foreign subsidiaries of U.S. firms from 10.5% to 21%. Okay, so basically, GILTI is super complicated. I'll probably do a video on GILTI at some point in time, but it's quite a mess to figure out how exactly it works. But theoretically, a foreign company could get a tax rate of 10.5% on their foreign income as opposed to 21%. Okay, and then they can take advantage of this participation exemption and things like this. Is it a good idea to say, hey, listen, like it's an anti-deferral rule? Okay, and this was one of the probably best from the perspective of getting tax revenue to the U.S. Rules that was brought in under the Trump tax changes. Okay. That being said, is it a good idea to go and double it to 21%? Well, I think first of all, the thing you should do is you should probably make it less complicated. That's probably the first thing that you should do. It will probably continue to incentivize companies not to be offshore. That's what it will probably do. So from that standpoint, it's probably going to achieve their objectives in that sense. What it will potentially do is, well, it's bad for foreign countries because of the fact that then funds are less likely to be kept there and reinvested there. Is it going to be making U.S. companies less competitive? That's a good question. So basically, here's the argument: is that, hey, listen, you're kind of getting double taxed, right? So if I'm in Germany, I pay German taxes, that's it. But here, I pay German taxes, plus if I have deferred income, then I'm going to end up being subject to GILTI tax. That's not good for me. I have less money to go and operate with. So I think that there's probably better ways to do it. I don't think that that's really a great approach, but it's certainly going to be bad for Americans. So what this is going to incentivize is we have some domestic U.S. structures that are really good for deferral at the domestic level. That's, I think, what this is going to incentivize quite a lot. That or for the types of clients that we typically work with who are kind of like 7-figure entrepreneurs, sometimes high 6-figure, depending on we're talking about profit revenue, low 8-figure, kind of like our normal clients, utilizing trust structures that get around this. That's probably the biggest thing that's going to happen here. So then they say, in addition to doubling the tax assessed on GILTI, Biden proposes to assess GILTI on a country-by-country basis and eliminate GILTI's exemption for deemed returns under 10% of qualified business asset investment. Okay. Again, this is kind of, I'm not going to go through this right now because it's too complicated to go through how GILTI works, but I would say, not a good idea. This one is, whereas the first one was, generally okay, like, questionable. I think it probably has a negative consequence, but, so-and-so in there. This one's a bad idea, and it has to do with kind of the exemptions that you can get from GILTI. Establishes manufacturing communities tax credit to reduce the tax liability of businesses that experience workforce layoffs as a major government institution closure, or a major government institution closure. Sounds like corporate welfare to me. I don't know, I'd have to dig into it, but sounds like corporate welfare. I'm against corporate welfare. Expands the new markets tax credit and makes it permanent. I'm not exactly sure what that is. Offers tax credits to small businesses for adopting workplace retirement savings plans. Okay, probably a good idea. If you have a small business, you implement something like that. Now, I'll do another video in the future about kind of some of the nonsense that's going on in terms of rules and what people can invest in. But generally speaking, I think that incentivizing building up good programs for your employees is probably a good thing. So, I wouldn't if you're going to give tax credits to small businesses for that. I'm generally in favor of small business tax credits. That would be generally what I would say. Expand several renewable energy related tax credits, including tax credits for carbon capture, use and storage, as well as credits for residential energy efficiency. Okay, so I mean basically a bunch of stuff for related to greening your company. Okay, I mean probably a good thing to incentivize at this point in time. We're getting to the tipping point where some of that stuff makes sense. I don't really have a huge problem with it. I think that there right now is an unpriced negative externality in fossil fuels. And so, you're trying to compensate for that. So, okay, that's fine. The proposal is not modeled due to a lack of detailed information. Let's see here. Imposing a new 10% surcharge on corporations that offshore manufacturing and services jobs to foreign nations in order to sell goods or provide services back to the American market. Would raise the effective corporate tax rate on this activity up to 30.8%. I think that's a bad idea. So here's my rationale for this. You generally speaking, your people benefit from lower cost of goods. And so if I can move someplace to get lower manufacturing costs, and then I can sell back into the US market, and that results in lower taxes for my people, that's a beneficial thing. So so Amazon typically hasn't paid much tax in the US. Okay, but what they've done is they've driven down the cost of goods and the convenience and availability of services for Americans. That has a net benefit aside from any tax portion to it. Likewise, you can look at a company like Google, right? Okay, you have Google Maps is free, right? That benefits people a lot. And okay, so that's a benefit that they get outside of the tax portion of it, right? In my opinion, what you should do, if you were doing a tax planning strategy thing, and this is something you can kind of play around with, is I think you should be in a situation where foreign companies selling into the US should be subject to tax. Now they're kind of doing that a little bit with sales tax, but it's difficult to go after. There's some nuances of how you would do that if you were doing smart tax policy. Again, bad for our clients, bad for us. I don't want to pay that tax, of course, but I think is probably fairly smart if you were to kind of go and do this. Established an advanceable 10% Made in America tax credit for activities that restore production revitalization, existing closed or closing facilities, retooling facilities to advance manufacturing employment or expand manufacturing payroll. Okay. So obviously they're trying to incentivize people to do stuff in America. This is a wave of nationalism effect that we're seeing here. Is this a good idea? Well, I mean, you can kind of break down the manufacturing numbers, et cetera, and see if it makes a ton of sense. It will obviously incentivizes American jobs. And so there's a certain benefit to that. It probably means that costs are going to be higher overall, but hard to say. You'd have to run the numbers on it. I like that it's even, meaning that it applies to everybody. It's not like a favoritism type thing where you're making a specific deal with a specific company. I think that's good. But on the other hand, I think that this is the type of thing that will only benefit big companies, not small businesses. So, you can go there. Equalizing the tax benefits for additional retirement. Oh, yeah. They're doing this stuff for 401ks. Yeah, I think the policies that they have on 401ks are probably bad. Eliminating certain real estate industry tax provisions. Probably a good idea. The real estate industry gets tons of benefits. And so, it's not fair. Expanding the Affordable Care Act's premium tax credit. I'm not sure the details on that, so I can't comment. Creating a refundable renters tax credit capped at $5 billion per year, aimed at holding rent and utility payments at 30% of monthly income. That's interesting. I don't know how that would work. That's I think that, so I'll do another video on California and explain what my view is on kind of rental and housing prices and things like this. Increasing the generosity of the low-income housing tax credit. So in general, I think that the whole approach to low-income housing is wrong, meaning that what you're trying to do is incentivize people to build low-income housing without addressing the root causes of why housing is expensive, which has to do with supply, which has to do with costs, which has to do with zoning, which has to do with landlord-tenant rules, etc. So in my opinion, I understand what they're trying to do, and I think that they're taking the wrong tact to do it. So I think that it's kind of like, hey, we have government involvement, which is causing problems, so our solution is to do more government involvement, as opposed to going back and relooking at our original government involvement. That's kind of my semi-libertarian approach. So anyway, that's kind of the overall of what it is they're talking about. I think that the biggest problem that I see in this is the corporate tax raises. I think that's a bad idea. Now, let's talk about what they didn't mention in here, which is good for us, which is right now it's very competitive for foreigners to form companies in the US. I actually think they should be doing more to encourage that, to be honest with you. I think that they should do some things where they incentivize, hey, listen, we want you to use US banking. We want you to use US payment processing. We want you to use, and that's handled on more of a regulatory rather than a tax standpoint. But from what it seems like, if Biden gets in, people who have US LLCs in the US and they have no US trade or business, et cetera, will still not be subject to US rules. That's pretty cool. So you can potentially get no US tax, even if they raise the tax rate. So anyway, that's kind of the little summary. I hope it helps you. Again, if you're an American and you're interested in lowering your taxes, or if you're somebody abroad and you're interested in lowering your taxes, reach out to us. You can book a call with me, clarity.fm/Michael Rosmer, or any of these other things. There's a link below. And please subscribe to the video. If you like the video, like it, share it with your friends, etc. I think that it's not a totally disastrous tax plan. I don't think it's hugely great either. I think that it's reflective of people who don't understand the international consequences, but they have a few things that are probably good and a few things that are probably bad. So anyway, that's my supposedly unbiased perspective. I will see you guys on the next video.